Hello everyone and welcome to the Navin Times Talk from the Heart. Legendary investor Warren Buffett defines investing as the process of laying out money now so that you receive more in the future. Investing is a sure way of making money. Of course, there are times you can lose money. There is a certain amount of risk involved. It is also not very easy given so many options. To understand the basics of investing, of investment, we have with us today a certified financial advisor who has over 2 decades of experience with blue chip organizations. In fact, he has given expert advice on various TV business channels such as CNBC, Bloomberg, Z Business and NDTV in the past. It is a pleasure to introduce you to Nelson D'Souza.
Thank you.
Hello, Nelson.
Hello.
Welcome on our show and thank you so much for coming on our show.
It's my pleasure.
It's so nice to have you because I've seen you on the different channels and now to have you in our studio, it really is lovely.
Indeed, my pleasure.
Nelson, the first thing that I would like to ask you is you are a certified financial advisor.
That's right.
You know, this is the first time that I've heard about a certified. I know that there are financial advisors.
Sure.
So is there a certain course or certification that is available today? Can you tell us a little about that?
Since 2013, the regulator for investments, if I were to put it in layman's parlance, the Securities and Exchange Board of India decided to pass a regulation which could control who could advise and who could not control investment advice. In the past, like you said, it was okay for anybody to be a financial advisor, but financial advisory is a science in itself. It's an art, it's a practice, just like that of a lawyer, a doctor or an accountant. So today, if you want to be a financial advisor, then you have to be a designated financial advisor, which means that you have to adhere to the code of conduct. There are exams and certifications that you have to achieve before you can actually call yourself officially a financial advisory firm or a financial advisor in itself. The first part of your question was, are there many? There are many, but it's still a growing community, and I think it's still not large enough to cater to the large population that our country has. I think as time progresses, the profession will grow in significance, and I think more and more people will start becoming more certified. There are financial advisors, but not everybody is taken the direction of being a certified financial advisor, and the regulator wants to make this a mandatory affair as time progresses. So
but why I'm sure the audience also would like to know, because we have been taking advice from people as far as our finance is concerned, but why suddenly this certified financial advisor? What do they have, or how are they responsible compared to a regular financial advisor? What is the difference?
Well, in the past, financial advisory was something that you could just do out of your basic knowledge of understanding markets, investment products, or simply by being probably an insurance agent. Right. You could get training at the insurance company and they would have products which could be similar to what financial advice could mean. But as time progressed and as markets started to go up, the unfortunate thing in our market scenario is that people get quite carried away when markets start to go up, the so-called bull markets, right? And many fall prey to ideas and thoughts that some financial advisors bring to the table. And as time progressed, SEBI realized there were a lot of complaints that were coming in from people who invested in areas they should not have invested, took risks which were not necessary. And therefore, at a certain point in time, SEBI said it's time to now become a more regulated industry so that people don't get carried away. There are people who can control how investment advice is made, and more importantly, SEBI has now given the label of scientific advice to financial advice, which means that anybody who wants to do financial advice needs to understand and learn the art of financial advice, and not just know what products are, but also understand aspects of the client itself. For example, if I'm going to deal with an individual who wants my financial advice, I need to understand the individual in many ways. which means I might have to understand his psychology, I might have to understand his risk appetite, might have to understand his financial background, his personal background, and then put it all together and understand whether a certain financial product suits him, or what else could I do for him from his personal situation. So it's certainly a science. It's certainly comparable to what a lawyer does, a chartered accountant does, or a doctor does, where the more the number of clients they have, the better they become as professionals, and their advice becomes better and better, better and better. So I would like to call financial advisory as a practice, just like any other profession, like those that I mentioned here.
Right. You, if I'm not mistaken, I think even audience have heard, he said something about psychology. He said knowing the client's psychology. What has psychology got to do with me investing and you as my certified financial advisor? Where does this come in?
So let me take one aspect to explain what psychology can do to your investment philosophy. The aspect of risk. Right now, a lot of people say risk is not something that I want to take when I want to invest. They'll say, I want guaranteed returns, so I have no appetite for risk. The word is appetite for risk. So now, this is not true for everybody. While it might be true for you, for somebody else it's not true. There are investment clients that I have who love to take risk. They say, I'd love to take a lot of risk because I know if I take the risk, I can make a lot of money in the markets. Vice versa, there are others who say, I can't sleep well if I'm invested in the stock markets and I can't take risk, right? Now, often people can't recognize this aspect inside them. Generally because, you get carried away with what people are saying around you. You see ads on TV about, investment products. You hear your friends tell you that there are investment products which will make a lot of money for you. And some kind of FOMO effect takes over, the fear of missing out. Now, a financial advisor can help you understand your own psychology, and through a questionnaire, a process, a psychometric analysis, can help you understand whether you are risk averse or you're willing to take risk, and how much risk are you willing to take. For example, it could be moderate risk, it could be a lot of risk, or could be very low amount of risk. So this is one way of defining how psychology plays a role in your investments.
You use the word psychometric tests. I'm sure you have heard it as well. And I'm wondering, psychometric tests? So if, for example, if I were to ask you to help me invest, will you be giving me a psychometric test? Is that what you're saying?
Yeah, so typically everyone follows a different model. There are some established models, there are some popular models. So when I say models, it means there are tested questionnaires which can be used where as and when the questions are answered, we get a sense of what is the client's mindset is all about when it comes to risk, whether they're willing to take risk or not take risks. These are scientifically done models where behavioral analysis with regard to expectations, analysis in terms of how somebody can react in different cycles of the market, for example. All of this is taken into account, and then a score is arrived at, and based on that score you get a sense of whether a person is risk averse or not risk averse. So that's what psychometric analysis would do to the whole process.
So you do this with all your clients. You do give them, a form to fill, or you may be filling it, whatever,
right.
and you find out how they are, in the sense, their mindset as far as investment is concerned.
Sure.
And then based on that, you are then going to, advise them about their investment. Am I right?
It is one element of what goes into creating investment advice. There are lots of other elements. To give you an example, it could be the goals that they have in their lives, the age itself, the age at which they are actually starting the financial planning, or it could be simply a factor of income. These are various elements that go into creating financial advice. So the element of risk, the element of psychology is one part of it, but there are also quantitative elements that I also take into account. Some of these which I mentioned just
Okay.
now.
My next question to you would be, and I'm sure all of us are wanting to know.
Sure.
We, a regular salaried person, or even a businessman for that matter, let's take it generally. the first part, if you can explain generally, and then you can speak about salaried people. So the first step, I want to invest money. What is the first step I have to take? What do I have to do? How do I go about it? Everyone wants to invest. Everyone wants their money to grow. Who doesn't? I do. I'm sure you too as well. So what do I have to do first?
Well, I would tell you the first thing to do is to find a financial advisor. But then,
I knew he was going to say that. I knew he was going to say that. Yes.
No, but I am also aware of the limitations of the fact that it's a growing community, and there might not be access to a financial advisor as quickly as we want it to be. But fortunately, we are in the internet age, and a lot of what I'm going to tell you now could be available on the internet, which could be used for the sake of starting the process. So first and foremost, we need to understand our financial plan. Now, all of us have computers today, all of us use Microsoft Office, and there is an Excel sheet that comes with it. So all of us can simply start by putting numbers in there. What numbers? Numbers such as the current salary that we have, the expenses that we have, the expectation in terms of goals we have for ourselves and our families, for example. Or
may I interrupt, please? When you're speaking about goals, can you give me one example of a goal?
Let's say, for example, if I'm a middle-aged man and I know in the next 5 or 6 years' time, one of my child is going to go to college, and the child has already expressed at this point in time that the child wants to be a doctor and is academically bright. I have a clear understanding that my child is capable of being a doctor, and I know therefore I'll have to provide for medical education, which is generally very expensive in our country. That becomes a goal in itself. And then if you have a understanding of what the timeline is, and you're pretty clear that this is going to be the surefire goal that is coming your way, you could then define what is the kind of a budget that you could have around it, and then work towards that goal by putting all those numbers on an Excel sheet. But it's not as simple as that. For example, the cost of something today is not the cost of something tomorrow. We all know throughout our lives the cost of something always goes up, right? What a 100 rupee note could buy 10 years ago or 20 years ago cannot buy the same today. And the same is the case for what it could do 5 years later, 10 years later, 20 years later. So I'm talking about inflation, which is a very common word, but a lot of people probably don't clearly understand it. It's a very simple factor, the factor of the value of money eroding, which means that what money can buy today, the same amount of money cannot buy tomorrow. So when you say that I have medical education to pursue in the next 5 years for my child, and in today's day and age it will cost me say 10 lakhs of rupees to send my child to, let's say, GMC here, then 5 years later that amount will change. So the thing that a financial advisor does is make a plan so that you get a sense of what that amount could be 5 years later, and so on. Right? Now, if you can't find a financial advisor, how do you calculate inflation? Very simple. Go on to Google, and if you could simply put the amount there and say inflation at the rate of, let's say, and inflation numbers are available on the internet at all points in time, and the government keeps publishing these numbers. So at this point in time, if I know it is about 4 to 5%, right, I could simply put it there. Or you can simply take an average of 5% for even 5 years later, and you'll get a number that Google will show up. And for you, it's a simple then, right? So you know it is going to be 11 lakhs, which costs 10 lakhs today. It's going to be 11 lakhs at 5% inflation. All you need to do is start planning for that 11 lakhs. Now the next part of the financial planning process is, how do I accumulate the money and how do I grow that money so that it is going to go to 11 lakhs? The more important question is it possible for me to do it, right? Not always you might be able to accumulate that kind of money because you might be constrained with the salary that you have.
Right.
A lot of us don't come with large salaries, or we're not into business, and therefore you'll have to look at alternatives. The financial planner's job is also to give you an alternative. If you can't accumulate that kind of money, the alternative could be looking for a educational loan, for instance, in the case of this particular goal. But let's say that's not the goal, for example, and it's a very large amount of expense, and your goal is simply that in the next couple of years you have to get a child married. Now most people don't take loans for these things, right? They accumulate money, they save money for the sake of having a nice wedding for one of your children in the future, right? You could work backwards. You could simply think what is the amount of money that you need for that wedding, and then
Right.
work backwards, and then start saving every month that amount of money and investing it in various instruments which are available. But the point is, you have to start saving them, right? Effectively, 30 to 40% of your salary has to be saved at any point in time. That is my understanding. And if people ask me for advice, how much should I save every month? I would say 30 to 40% of your monthly salary should be saved. More often than not, a part of that already is saved, because today the government wants most people to contribute to provident funds, and companies are obliged to do that. So there is automatic saving already, but that does not accumulate to 40% of your salary.
So are you saying when you are saying invest 30 to 40%, you're speaking besides the provident fund?
I'm saying including the provident fund.
Okay. So the provident fund plus this.
Yeah.
But what happens, like you rightly said, that there are people who barely make it through the month with their salaries. In a situation like that, what can one do? How does one go about it unless they take up another job?
Well, then you have to grow the capital, the little bit that you can save, as much as you can. And to grow anything, you have to take risks. Now, taking risk is a function of time in a big way, because the more the time you give to an investment product that has risk, the better the chances that you will not make a loss, and the money will grow at a pretty good rate, which basically means that it is advisable for younger people to enter investment products such as stock markets, mutual funds earlier than later. Someone who is in the middle ages can also get started, but the amount of time that he has will be far more limited, and therefore if he is limited in terms of the income that he has, he is constrained with the amount of risk that he can take. So as
Right.
somebody progresses towards retirement, effectively most of my clients who are older, senior citizens, I generally don't have any money in the stock markets and equity mutual funds, for example, because I know that the time is already over to be able to take the risk. After that point in time, there's uncertainty, obviously, because it's a later stage of your life, and therefore the element of risk pretty much goes away from your life. You don't have the appetite, neither anybody has the time to give. You never know
Right.
what is tomorrow, and therefore it is better to start early. Ideally invest in market linked products, so that even that little money that you save on a month-on-month basis can eventually accumulate and become a large amount of money, and the power of the stock markets will start showing in the longer term.
You said that we need to start early, especially youngsters.
Yes.
So if for example, someone who's 24, 25, or early 30s, is that a good time to start investing, or do you think it should be earlier?
It should be earlier. I mean, I encourage youngsters from the time they start earning, even if after the age of 18, and if they have money which is accumulated from pocket money, or today kids do a lot of odd jobs,
True,
which is
true.
very unlike my generation, right? Put that money away in an SIP, in a mutual fund. I wouldn't recommend buying stocks directly, which I will talk about a little later, why and why not. A mutual fund is a great vehicle. Sometimes even there are great insurance products. The earlier you, for example, buy insurance, the cheaper it is for you. And if you buy an insurance product which has investments integrated into it, for example, the ULIPs, unit-linked investment plans, which are available with most life insurance companies. These are great vehicles for youngsters to start, and over a period of time they will see that they have made a lot of money because they have been part of the stock markets, the markets journey. At the same time, they have developed a discipline to save. There is a high propensity for people when they start earning to spend money, because it's a material world. There's a latest phone around.
And I think, Nelson, it's more about that age. You're in that age where money, you believe money is to be spent, it's to be enjoyed today, because like they say, who has seen tomorrow? That's all I have, this is what I have. And you want, I'm sure when you speak to your children and tell them to invest, they are like, let it be, it's okay. We need to enjoy. They say, chill mom, let us just enjoy. So you are saying that mutual funds and ULIP, these are the two that you would recommend
for youngsters.
For youngsters.
Because it's easier and simpler, and you can put very small corpuses as small as 500 rupees and get started on a monthly basis. and this money can grow to a very large amount of money. It's better to start early than later. While I know there is the urge to spend, and I don't want to burst anybody's bubble with having a material life, you need to balance it out. But at the same time, it is good to be responsible and think about the future. The other aspect that I want to bring in, along with the savings and investments, it's very important to take life cover as well as to ensure you have taken a health cover for you and your family. There is one important element in insurance that you should know, that the earlier that you take insurance in your lifetime, the cheaper it gets. And most people wake up very late to this thought that I need insurance. Generally, in the middle of your lifetime, you suddenly realize, because of a sickness or a small problem that you've had with you or your family members, you decide to take insurance. And you realize there's so much that you need to pay as a premium. But if you realize this much earlier, right at the time that you start working, insurance will come far more cheaper and you'll have more cover for a much smaller cost.
So you're recommending the moment someone starts working, they should look at life insurance?
Yeah, the first thing they should do is get life insurance in place, both for themselves as well as a health cover which covers them and their family members. That's the first thing that they should do, because it gives them the benefit of a lower cost and coverage right from the start.
And a longer period. It is
absolutely.
divided over and spread over a longer period.
Absolutely.
So that makes it easier, I suppose, to invest. You have been speaking about youngsters, and you said, especially in Bombay, they are more aware. Do you feel comparatively that youngsters today are much more, knowledgeable and well versed in investments than they were, like 15, 20 years ago?
Absolutely. When I compare my time to the people that I see of the generation now, thanks to the internet, they're far more aware. In fact, just the other day when I was sitting at a restaurant and having tea, I had a gentleman peeking into my phone screen because I was looking at the stocks that I hold, and I was looking at the markets, and he said, "Oh, you're in the market space." And I said, "Yeah." So he says, "I also am." So I asked him, "How old are you?" He says, "I'm 20. I said, "That's
wow."
lovely." Yeah. So I asked him, "How did you start?"
So commendable.
Yeah. And I asked him, "How did you start?" He says, I was on the internet and I was part of a few forums and groups, and they were talking about how money is made in the markets, and I decided to start early. In fact, even when I went to the saloon to get a haircut the other day, I had the barber who was speaking into my phone and saying that I was looking at the markets, and he asked me, "Do you have any stocks that I could buy?" And I said, "How do you know?" He says, "My friends have, there are so many online websites today, so my friends are on it, and these are all youngsters, and I have started investing in the stock markets." All this is good. My trouble is that a lot of them are getting into it blindly. You got to be aware of the risks at times.
You have to study the market, basically.
Not really. I mean, stock markets is not for everybody, to be honest. I mean, when I say stock markets, directly buying shares is not for everybody. I would want someone to be well aware of the stock markets, understand how to read through the various technical elements of being part of the stock markets. For example, understand the company, understand the price at which a share is getting traded. There's so many elements to that. Generally, a more experienced person has more success in buying shares directly than somebody who just gets in there just because there is a rally in the market or a friend telling you that he's made a lot of money. My suggestion is, if you really want to be part of the stock markets, try and use the route of mutual funds. Mutual funds are one of the most convenient vehicles that the world has discovered to invest into the markets. They're more than 200 years old in the world, and I think in India the industry has grown by leaps and bounds in the last 20 years. It's the easiest way a layman can invest into the markets. There is a fund manager who ensures that he does all the homework in terms of which companies to invest in. There is a research team which studies behind the fund manager. They study the markets, they study the companies and the industries. And there are various ideas that these fund managers come up with, which me and you might not necessarily know because they are in and out of the market every day. At the same time, it gives you the opportunity to invest very small amounts of money and invest into the stock markets. For example, if you have to buy a share such as an MRF, a single share of MRF could cost you up to 80,000 rupees, right? But if you go through, let's say,
that's for one share?
That's for one share. right? So if you go through a mutual fund, right, even if you have 500 rupees, you are part of a pool of many investors. That entire money which is pooled will buy that MRF share in many lots, and you still can participate in the same MRF share through a mutual fund route.
So I will be a minuscule part, whatever, but I will still be a part of that MRF share. Now, a very important question. We have been speaking about different types of investments, but can you just break it down and make it really simple? Because whenever someone speaks to me about finance, investments, it goes over my head. It's so difficult, I cannot understand what it is. So can you please, Nelson, make it so simple that even a person like me will understand what is a mutual fund, what is a stock, and if there is anything more than that, whatever you're going to explain, I would request you, for people like me and for people out there, to make it as simple as possible, so we at least understand the basics, if not the advanced version of whatever there is out there.
So traditionally, people have understood investments as fixed deposits, gold and real estate, and they continue to be excellent vehicles for investing.
Right.
And it's easier for people to understand this because you can touch and feel most of these investment opportunities, except the FDs. Even FD in a way, touch and feel, because it is a certificate. Now, apart from this, mutual funds and stocks are also there. There are even other instruments that appeal to a lot of people in certain segments. For example, there are senior citizen schemes which are available for people who are above the age of 60. Or there are schemes which can be used for the sake of giving yourself a pension. For example, the National Pension Scheme exists. So there are tons of various investment options available in the market.
These are all government?
Some of them are government, some of them are semi-government, some of them are private. But the point is this, the point is that there are lots of investment opportunities. I'd like to simplify it because it's for a common man, right? For a common man, my suggestion is look at mutual funds. Ideally try and not do stocks directly unless you have the knowledge of doing stocks. There is a investment category of bonds for those investors who are willing to invest in an instrument which gives them a fixed rate of return and want regular income. Bonds are a great option, but then bonds might not be always available directly to investors. Going through a mutual fund, you can also access bonds, for example. Then there are insurance-based investment products called ULIPs, which are an excellent combination of insurance and investment that also gives you a tax-saving option. And if you can take care to do some study on the expense of these, in the sense that each of them come with a certain amount of cost. If you can compare and see what is the best cost option you can find in ULIPs, you can also invest into that. Now let me break it down for you. The most common one that people want to know is what is a mutual fund. And
right.
Very simple. A mutual fund is a pooled vehicle of various investors putting their money together, giving it to a mutual fund manager who has an idea about where he wants to invest this money. So a mutual fund vehicle has an objective, a stated objective in the prospectus, which says they will invest their money in a certain sector. Now mutual funds could be of different kinds. They could be equity mutual fund which only invest in stock markets. They could be debt mutual funds which invest in instruments such as bonds, for example. Or they could be hybrid, which means they could be a combination of equity and debt. Securities, which mean fixed income instruments such as bonds, money market instruments. There are lots of instruments that the government issues which might not necessarily be available directly to a single individual to invest, but institutions can buy on your behalf and invest into these. These instruments give some kind of guarantees on the investments that are made, and then there's a regular amount of interest that is getting paid. But all of this obviously does carry risk,
right.
And that risk is managed by the fund manager. To put it back again, equity mutual funds invest in equity stock markets on your behalf using a fund manager and a vehicle. Debt mutual funds invest in instruments which are supposed to be fixed income instruments, which have underlying instruments inside those funds, which invest in instruments which give you regular income, which give you some amount of tax benefits, as well as some amount of security, if not entirely. So all of these suit different people in different ways. As they say, different strokes for different folks.
Yes.
The financial advisor's job is to try and make it useful for the kind of a person who walks in for advice. So for example, younger people come to me, I generally advise them almost largely an equity portfolio, which means that I tell them put most of your money in equity mutual funds. And then again, there are subcategories that I don't want to get into right now because it might complicate. And for someone who comes in the middle ages, I might put a part of the money in equity mutual funds and a part of the money in debt mutual fund, which might not be necessarily an equal split, but depending on his situation, his condition, even the age that he comes into me.
And the psychology, like you mentioned.
Psychology also.
Yes.
And then eventually for the older folks, it is going to be purely investing in debt mutual funds, if I just take mutual funds as a category. So this is the simplest way to invest. If you have to do it yourself, I call it the DIY investor. The best way is to go on to the internet, and there are some reliable websites that you could use. I mean, I don't want to name anybody for the sake of proprietary, but and today people have figured a way to review. People review websites, review products, so it's easy for somebody to understand what is a reliable site, not reliable site. Look at the research and then try and use that research in your financial plan. So if you put everything on that Excel sheet like I mentioned earlier, and you know what your goal is, how much is that you need to save, then it will be easier for you after you've done that to pick one of those mutual funds which suit you and invest into it. And that's as simple as that. Now the other way to do this is to use a financial advisor who does a more detailed job, goes a lot into depth, and your success rate, if you could use a financial advisor, a lot better than doing it yourself. Because the other element that you need is that you need a mentor when you're in the markets, because I have always noticed that people who are in the stock markets, they get panicky if markets go down, for example, right? But these are cycles in the market, and it's important at times for somebody to be there beside you to tell you and look through these cycles and tell you to stay calm, and tell them that this is for the longer term and therefore you need to stay invested, don't take your money out. That element, I think, is the one thing missing when you do it yourself. But if you can understand the science behind why you need to be invested for the long term, probably that wisdom will dawn on you right away. So equity mutual funds is a vehicle which invests your money into the stock market with the help of a fund manager. What you can't do on a daily basis, he does for you and ensures that your money is growing.
So this fund manager that you are speaking about is the companies, like whichever company I invest in,
Sure.
they have a manager who decides where my money will go. Is that what you're saying?
Yes, there are more than 40 mutual fund companies in India, and some of them are the best in the country. There are 5 or 10 which are top rated, which whenever you go on the internet you'll find the common names. All of these fund houses, we call them fund houses, they have fund managed for each of the funds that they have. Now this is where the challenge comes, that if you're doing it on your own, often people don't know where to put money in. I've seen people get carried away, especially during these corona times, that they thought putting money in healthcare companies is good because they think stocks of pharma companies will do extremely well, which is true, which did well, right? But as we speak, is it the right time? I don't know, because we have gone through 2 waves and I don't know whether those companies will continue to do well. I don't know this, right? So the same will be the quandary for a layman when it comes to investing in one of these pharma or one of these sector funds. This is where the fund manager comes into play. This is where the advisor comes into play. The advisor per se, because he will be able to then tell you exactly whether you should have a pharma fund in your portfolio or no. But for those who can spend some time reading and understanding the science of investment advice, could actually do it on their own. The simplest thing to do is get into some traditional old mutual funds, such as the large cap funds, the blue chip company fund. There are some very conservative equity mutual funds which are available in the market, which invest in the top 100 or 150 odd companies, which we believe are very large companies. And if you stay invested in some of these for the longer term, between 5 and 10 and 15 and 20 years, these companies will only continue to grow in size and continue to grow in size of value. For those who want to make it simple, I just tell them, if you don't want an advisor and you are willing to take the risk and you have the age on your side, simply invest into an equity mutual fund, into a large cap mutual fund.
For a normal person who doesn't want to take a very big risk and doesn't want to lag behind, because we all want to earn money, what would you recommend?
Age is an important factor. If I have to simply answer it and say how much risk you want to take, I would say if you're younger, then I would say you can invest in mid caps, for example, and stay invested for the longer term, because the risk will eventually be managed through the cycles of markets. But if you're older, then I would say, and let's say you're not yet retired, but you're somewhere midway, you're a middle-aged person, then I would say you could probably be more aligned towards large cap mutual funds. But I would also encourage that you start bringing in debt mutual funds into your portfolio, depending on what your age is. Now, there's no really a science to this as to how much percentage, but sometimes they use this life cycle so-called theory, which is the thumb rule that the age of a person, for example. So, for example, if I'm aged 50, let's say hypothetically 40, for example, if I'm aged 40, 40% of my money could be in, say, debt, and 60% of my money could be in equity. Just it's a way to, for example, find a parameter to be able to do this. So as you get older, for example, the allocation goes down. So for example, if I become 60, then my
the debt increases, the
and
debt
equity
part
comes down. That's a simple way of doing it, but then people use different models to do this, different firms, different advisors, different models. There's no really one single proven model, but the logic is that as you get older, the element of risk has to come down in your portfolio, which means you should start moving towards more debt mutual funds
and less
or
of equity,
FDs, and or anything that is considered to be safe or semi-safe. That is the way it works. So this is common sense. Right. So you're younger, you can take more risk, you can get into mid caps and small caps. But if you're older, ideally try and reduce your exposure to these kind of categories and be more in large caps, and try getting into debt mutual funds as much as possible.
From whatever little I have been speaking, and I'm sure you agree with me, I'm sure even you have understood that mutual funds are divided, please correct me if I'm wrong, mutual funds are divided. The two that I'm going to be speaking about, which he spoke a lot about, was the debt and the equity one. Am I right?
Yeah.
Generally, this is a larger,
this is a very
broadly speaking.
Yeah.
So with ULIP, not only am I investing in some company in whatever form, but I'm also getting insurance.
Yes,
is that
absolutely. Plus, you're also getting a tax break, because the government gives you tax benefit for being invested in ULIP instruments.
So with this ULIP, do I get money every month, or is it just at the end of the term? How does this
so again,
work?
all of these instruments generally are better to be invested for the longer term, right? ULIPs are generally with a 3-year lock-in. I find a lot of people sometimes investing only for a period of 3 years, because the advisor or the insurance agent would have told them after 3 years
you can withdraw your money.
People are always worried about liquidity, right? My suggestion to people is that when you take a plan, if it is a 10-year plan, stay the whole 10 years. If it is a 20-year plan, stay the entire 20 years, because if you don't, the purpose of the plan is not served. At the same time, if you try and remove your money early, the cost of premature withdrawal is very, very high. So this is a very important aspect for investors to understand, especially when it comes to investing money in ULIPs.
Okay. So much of information. I'm still processing it, but I think I'm going to take some time to process it. I will have to watch the program and digest everything he says. Everyone wants safety. Our money is our money. It's hard-earned money. We want to keep it safe. We want to make it grow. Which investment, according to you, is the safest? For a salaried person, which one should I go for?
Well, the whole concept of safety is very controversial, because I think safety is guaranteed as long as the person who guarantees it exists, right? Now this is true for a company or even true for a government, right? We have seen over the last many decades, countries have vaporized because of wars, because of crises. So I don't believe there is anything that is 100% safe, but to some extent, you can put your faith in the country's system, the governments, and believe that some instruments come safe. For example, fixed deposits are safe up to an amount of 5 lakhs of rupees in any bank. Most people don't realize that it is only up to 5 lakhs of rupees. So tomorrow if a bank does go bust, fortunately in our country we have never had it, because we have got great regulators and the country has a great system in place to protect people. But if it does, then it's up to a sum of 5 lakhs per bank that you will be insured up to. So the government has a reinsurance model behind every bank, which ensures that every depositor is protected up to 5 lakhs. Now that doesn't mean that you can't keep money more than 5 lakhs. This country has a great, like I said, a great governance model, and therefore our banks they do a great job in ensuring that they are doing great risk management and taking care of our money. But the other way to try and manage the element of risk is to diversify. Never put your eggs in the same basket, and therefore try and be diversified, not just with banks, but even with your mutual funds and everything that you do when it comes to investments. Diversification is the key to reducing your risk substantially. To answer your question on
which is safest?
Yeah, for a salaried person, what could be a safe avenue? Now again, like I said, if I am simply asked this question, I'd simply tell people that put money in a fixed deposit. I mean, there's nothing else that could that can be seen as safe and for a lay person, right? But the answer is simple, but the reality is not as simple, right? Today, if you invest money only in a fixed deposit, at the best it will only beat the inflation. It will never be able to make more money than inflation. At times, maybe with 1 or 2 banks, you might be able to make 1% or 0.5% more. It is therefore important to look beyond the idea of safety and understand your situation, where you come from, and then see if there is scope for you to take a little risk and incorporate the element of risk by including stock markets and other instruments which have an element of risk. Like you said earlier, that unless you take a risk, you won't make a return, and then blend it with
something that's safer, so balance it basically.
So have money in FDs, at the same time have money in some equity mutual funds, have a balance, and that way you will have the best of both worlds, right? You will also have money which is on the safer side of it. At the same time, some amount of your money is invested in the markets. Now, like I said, if you're younger, I would completely advise any younger person to try and be a part of the stock markets and plan for a longer future than simply putting money in FDs. I've seen youngsters sometimes, because probably it is traditional for them, families do it, the parents do it, they end up putting money right at the start directly into fixed deposits. Whilst fixed deposits are safe and will give you regular income, but they might not grow your money in the future. And if you don't grow your money, the risk is that you might have lesser money by the time you get older, or you reach one of your goals, or you even reach your retirement, than you should have had. I find often people come up to me, tell me that, Nelson, I saved a lot, I planned a lot, I put all my money in FDs, but I realize the money is not just enough. And they tell me, why did that happen? And I tell them, that's because you never took a risk when you should have taken the risk. Because if you did, then a part of your money would have grown faster than inflation, and your money would have been much more, and it would have been good enough for the times you're in today.
So, from what you said, if you do not take risk, then your money cannot really grow much, right?
With the disclaimer that you have to be of the right age group to take risk. At the same time, you should also have the risk appetite. There are times that I've found youngsters aren't willing to take risk, and I don't want to stress them. I tell them, look, if you can't take risk, don't take risk. I'm not going to force risk on anybody, but yes, an element of risk in investments, if you're younger, is necessary, because it will only add value.
And for the older
people, ideally, I would not advise taking any risk. I would tell them that conserve what you have, and try and be invested in safe fixed return instruments, because you need to safeguard what you have, because after a certain age you might not have any income at all, and then if there is no income, then what you have is all that you have, and you have to live off that. So try and be less on the risk, on the side of risk, and more on the side of safety.
What very important question, I've heard people speak about it, I don't know if you have, but something called paper gold. What is paper gold? I know gold, but paper gold, what is that?
Yeah, so today if you have to buy gold, what would you do? Either you buy jewelry, which is generally ornamental in nature, or some people buy coins and bars, bullions. There are people I have also seen places like Bombay who buy bullions. Right? Now, what are the challenges with buying gold in physical form? First and foremost, safety. Right? I mean, if you unless you've kept it in the bank locker, there is a chance of it being stolen.
Right.
And that becomes the biggest problem. Secondly, there is the element of wastage which comes with a lot of physical gold that you own, because when you do ornamental gold, there's always mixture and things like that.
Yes,
right?
and the breaking charges and
Yeah,
things
correct,
like that,
correct.
and
And
making
then
charges.
Prices are not, the third factor is that prices are not very uniform everywhere, right? Sometimes prices differ from city to city. They differ from even jeweler to jeweler because there are making charges and things like that, right? It's very difficult to really find reliable gold, and often in Indian culture, you find somebody you can trust, a goldsmith who you can trust, and you go to him, and if he turns out to be a good guy, great for you. Otherwise, you know, you might have suspicion about, you know, whether he's giving you the right price, right mixture, quality of gold, etc. One way of actually looking at gold as an investment, purely as an investment and not from an ornamental point of view, is looking at the paper gold option. This has been introduced a while ago. You could invest this through mutual funds, or you could even invest it through some of the government schemes that have been coming out. For example, the sovereign gold scheme that has been introduced a while ago. I think this year we have had about 5 series of these gold schemes. So what happens here is you pay money into these schemes or into one of these mutual funds, and that money is invested on your behalf to buy gold. And this gold is pure. It is stored in vaults. It is regulated through the RBI or any other regulator that is responsible. And most importantly, it has got, in the case of, for example, gold ETFs, which is a form of a mutual fund route investment, you also have the element of liquidity. So, for example, whenever you want to, you can actually sell it off and come out of that particular investment. In the case of a sovereign gold scheme that has come out from the government, apart from the fact that it gives you highest quality of gold and safety, it also gives you some tax benefits. It gives you a small return which the government guarantees along with the appreciation in the gold itself. So paper gold is caught up largely because of these elements. The government wants to monetize gold because India has a lot of gold in their household, one of probably the richest nation when it comes to gold all over the world.
We all love gold.
Yeah,
we love Indians love gold, yes.
Trivia here is that India is one of the largest importer of gold in the world. We have a lot of love for gold, and I think if we add up all the gold that is available in the households of India, India would be deemed as one of the richest nations in the world. So the government wants to therefore monetize the gold that is there with people, and that's why they've brought out these schemes. The benefit of these schemes for people like us is that it gives us a transparent way of investing in gold, where there are no ifs and buts about wastages, whether the price is right, whether the quality is right, and we don't even need to worry about the storage. So the government does, or the mutual fund does the job on our behalf and takes care of all of this. So if gold as an investment is your option, then I would highly recommend paper gold over physical gold, unless you have need, for example, in families where they have weddings and they have to plan for gold in the family during weddings, then maybe you might have to buy physical gold. But if it is an investment and you really want to take advantage of gold as an investment, it is better to buy it in paper gold form. But I'll tell you a bigger reason for me as an advisor that I invest in gold. For an investment advisor, the gold asset class is considered to be a hedge. The word is hedge, which means that all of us advisors, we advise our clients to have a certain percentage of their portfolio in gold in some form or the other, because gold is the last resort investment option. They say that towards the end of any crisis, you eventually resort to selling the family jewels, which basically means you sell gold, right? And there is dependency on gold at any point in time in the hour of any crisis. The same is with investments. Having gold in your portfolio gives a sense of protection to your portfolio, because you know, worst comes to worst, gold will always have some intrinsic value, and
it will, yes.
It will ensure that there is safety. Now, if you see during the Corona times, if there is one instrument that actually did extremely well while everything went down, it was gold. Gold rallied by multiple percentage points and has never seen a rally. The last rally I think that we saw in gold was in 2008 when the great economic recession took place. After that we have not seen that sort of a rally, but we have seen historically over the last 200-300 years of the markets existing, we have noticed that gold has always rallied whenever there is a crisis in the market. So it is important for you as an investor to have gold for the sake of hedging, for the sake of creating a safety net for your finances.
So if I tomorrow want to invest in this paper gold, all I have to do is tell my financial advisor that I want to invest in gold.
In paper gold.
In
Yes.
paper gold.
Yeah, there are various options for paper gold which he will bring to you. So which is like, for example, a gold mutual fund or a gold ETF, and now there are the Government of India schemes, which are the sovereign gold schemes, which have been rolled out since the last year. I think for the last couple of years there's been this sovereign gold scheme that has been coming out. As we speak, I think we just finished the 6th tranche. I think there were 8 tranches. So all people have to do is look out for these notifications that come out in the newspapers.
So how often do they come out, Nelson?
The periodicity is not defined by the government. I mean, it's defined in the sense that the last time when they had announced there will be 6 to 8 phases, so 6 to 8 series, which is now taking place. So at different points in time, there were different prices depending on what the gold price was globally, and the government rolled it out at different points in time. I think one just concluded now. So this will be available on most major newspapers every time the gold scheme comes out. At the same time, your advisor will be also aware of when the schemes are coming out.
So if I have X amount of money, would you advise me to put a major part of that, you know, a huge chunk of that money of mine into paper gold? Do you think it's good?
No, I wouldn't put it that way. I would say between 5 to 10% of your portfolio is reasonable amount of money to be invested in gold, because if you put too much money in gold doesn't really grow per se in
Very
the manner of
fast.
the other investments.
Okay.
So you see that in the times of crisis, but a crisis could arrive once in 10 years, once in 20 years. So if gold grows at the same rate as generally inflation does, so which means that it just beats inflation and it doesn't really give you growth per se, right? So if you are only trying to achieve growth by the means of gold, then it is not a great idea. You need to have gold as safety. 5 to 10% makes reasonable sense. If you are very conservative, maybe you can go up to 15 to 20%, but very rarely do people have that kind of allocation in paper gold. Now if you really add up the value of gold that is lying at home and in your lockers, maybe it might tantamount to a much larger percentage.
Yes.
But if you want to do a proper allocation on paper through a paper gold route, then 5 to 10% is my advice.
All right. And the last question, we have time for just one, and I think that's a very important question, is we have people from out of our country investing in India, and we are opening our doors to investors. But what about us? Can we invest in foreign markets as well?
Yes, we can. The Indian government has created a window through a route called the Liberalized Remittance Scheme, LRS. This scheme has been in existence for almost 20 years now. So through this particular route, you can actually invest in foreign markets up to $250,000 in a year per person. So if there are, let's say, 4 family members in a house,
right,
if each person can put up to a maximum of $250,000, then $1 million can be invested in the foreign
in
markets.
One family, from one
in
family.
a single family.
Yes.
And there are today banks have created ways and means for you to invest outside by tying up with foreign banks and foreign brokerages. Now this is the more complicated way of doing it, because it takes a lot of paperwork, opening an account, and not many of us, and foreign brokerages also at times ask for very large minimum sums to invest. So the easier way is through the mutual fund route. The mutual fund route has a category called the international funds category. In a technical way, it is called as feeder funds. What happens here is that an Indian mutual fund will invest on your behalf in foreign markets.
Okay.
There are lots of mutual funds today which invest in US markets. So if you want to, let's say, be part of the bull run in America, and you want to be part of a stock such as an Apple stock or a Microsoft stock or an Alphabet stock, you can actually be part of all of these through Indian mutual funds which have international funds within them. So there are about 7 or 8 interesting funds in the country through which you can invest into various markets globally. You can even take exposure to Japan or for China or ex-China or Europe or America today through simply using this particular route. But if you are very savvy and you want to be buying, let's say, the Apple stock itself, then you can use the LRS route to invest into
But
these
like you
markets.
said, there is a lot of paperwork involved, and
yeah, it is, I would say, a little more complicated, because you have to open those accounts and do it, and then you have to find the broker. I think banks are trying to simplify this. I'm getting to see a couple of institutions simplifying this and making it easier. They are even giving them online access today through their Indian online websites. I don't think forever this is going to be complicated, but yeah, at this point in time, it is a little more complex in comparison to investing in a Indian mutual fund which invests into foreign markets.
Right.
So my suggestion and piece of advice to those who want to be part of the international market is to use the Indian mutual funds, international funds, to invest into these markets. Unless they really are savvy, then they should look at the LRS route.
And then they can do it on their own, and
Yes,
that's fine.
correct, yes.
But otherwise, you would advise that we go to a
Indian mutual fund.
certified financial advisor,
Yes,
which he
yes,
is.
yes.
So we've come back to the round. It's a round circle. We always come back. We have learned so much. I'm sure you have, like I have. So much to process, of course. Like I said, I will have to sit and write down everything, watch the program and write down, because the tips he's given, the knowledge he has shared is amazing. It's going to take some time, but I think we've learned a lot.
It's a start.
It is a start. It definitely is a start. So next time someone tells me, have you invested, I will ask them, in mutual fund, I'll ask them which one, equity or debt. Can you believe it? I'm going to do that. Any which way, Nelson, thank you very much for joining us and sharing so much of knowledge. And to all the audience, thank you for the time, the effort of joining us and listening to us. We appreciate your time and effort, of course, and we'd love to hear from you. So if you have any questions, can the audience send some mails?
They can
send
send the queries
Yes,
to you. I could answer.
Yes, you can send it to us. Our email address is planetj@therateofnoventimes.com, and I will definitely forward it to him, and the answers, once they come, I will send it back to you. So yes, thank you again, and until next time, do take care of yourself. Bye from all of us.